All right, welcome back, guys. This is the 9th video in the series of our ultimate guide to trading. Okay, this is the ultimate guide. We're almost done with establishing the foundation. After this video, all we have left to do is teach you guys how to read a chart. And then once that's done, we get into the indicators and exactly the how-tos of how do we make money, right? The how-tos of what we're looking for and things like that. So you're almost done. We're so close of establishing the fundamentals. Once we've gotten past that point, then we can really get into the meat and potatoes of exactly what we're doing and what we're looking for in order to make more money. So let's go ahead and dive into it. This video is going to be over the basics of leverage trading. I'm not going to go much into the how-tos of the mechanics of how to leverage trade. The primary focus of this video is to understand what leverage trading is, the overall impact it has on the market, what are some things to look out for so you don't get burned by leverage trading, and how you can take advantage of leverage trading, whether or not you are doing leverage trading or if you are only buying spot. But if you understand the mechanics of how leverage trading work, you can take advantage of leverage trading despite the fact you're not even using it. And I'll get into that later and it'll all make sense at the end. But the point is, this is a very important video. Leverage trading is extremely prevalent in crypto and it has a lot of impact in the market. It really does. So really great stuff. I think you're in for a good one here. This should be a pretty long video, but this should be the last one before we get into the meat and potatoes. So let's go ahead and get started with it. So the first question is, what is leverage trading? Leverage trading is using somebody else's money to make more money. Pretty easy, okay? So you are borrowing money from somebody else in order to make more money. Nothing wrong with that, okay? And let's go ahead and get into it. This will be a very elementary example, but I think this is a really good way of understanding it at an elementary level so that you can apply it later into these more advanced concepts. So you are in the market to buy and sell bikes. Okay, bike. Don't worry about the model, don't worry about the brand, don't worry about it. In this scenario, there's only one type of bike, and all these bikes are worth right now today $100. Okay, so bikes are worth $100. Well, you expect the market to go up for the bike market. Okay, you expect the market to go up. So let's say you expect to go up to $125 or $120 per bike. That means you're expecting a 20% increase in the bikes. So what do? You have $1,000, and instead of buying 10 bikes, you instead go to the bank and you put that $1,000 as collateral and you buy 100 bikes. Okay, so option 1, buy 10 bikes with own money, right? Option 2, buy 100 bikes using bank's money and having the $1,000 as collateral. Okay, those are our two options on making the money. So let's see how the option 1 works out. Option 1, you buy 10 bikes, you sell it for, you buy 10 bikes, the price gets up to, so buy for $1,000, sell for $1,250, which means you make $250 in profit. Pretty easy, huh? So you buy for $1,000, you sell for $1,250, you make $250 in profit. Not too bad, right? Option 2, we expect it to go up, so we go to the bank and we tell the bank, they're like, hey, can we get these bikes? They're going to charge you a small interest rate like every bank will. You're going to go in here, you're going to say, all right, cool. So we're going to buy for $10,000, right? We're borrowing the money from the bank We're buying for $10,000. Sell for 12,500. Which means we get 2,500 in profit. Now the bank is going to get, now you're going to get your collateral back. You get collateral back. Bank gets its 10,000 back. And they charge a little bit of interest. Okay. So 100 bikes. Yeah, 100 bikes times 100 is $10,000, right? You borrow that money from the bank. You borrow 10,000. You wait a little while. It goes up to 25% you were expecting. Did I say 25? Whatever. 120, 125. I meant to say 125. My bad on that. So 125. He expects to go up to 225. So you go over here. You buy it for 10,000. You sell it for 12,500. So 2,500 in profit after you give the bank back their money. And of course they charge a little bit of interest. Like they're probably going to charge you $50 in interest. Cool. So as you can see, in this scenario, you made $250 because you used your money. In this scenario, you made $2,500 because you used the bank's money to leverage and make more. Awesome. So I hope that makes sense on how you can borrow the bank's money in order to make borrow the bank's money in order to make more off the same movement in price. This is leverage trading. This is spot trading. This means you're using your own money, your own spot money for your trade. Now let's go to the second scenario. It's a little bit harder to understand, but you have to understand this. This is very, very important in the market. Now, bike market is currently at $100. You expect the market to go down to $75 per bike. Okay, so the bikes are worth $100. You expect the market to go down to $75 per bike. So you have options here. The first option is to just wait until the market does drop down to $75 per bike and then buy the bikes at $75, right? That's a good, reasonable idea. But what if you want to make money off this movement right here? $100 to $75, that's quite a big movement. I bet there's a way you can make money on that way too, right? Well, if you have bikes available to you, you can sell your bikes right now for the $100. And then when it drops down, you can rebuy them. That's an option. However, you can also do something called borrowing bikes from somebody else and then the market drop down and then give their bikes back later once the market has dropped. I know it sounds a little weird, but stick with me, okay? So Bob owns 100 bikes. Okay, Bob owns 100 bikes. You go to, or let's say not Bob, let's say the bank. Bank owns 100 bikes. You go to the bank and ask for the bikes temporarily. Okay. The bank says, yes, you can have our bikes temporarily, but you're going to pay an interest and you're also going to put up some collateral. The collateral is going to be money, realistically, right? It makes sense. So they're going to say, hey, give us some collateral, and you're going to pay 1% per week or $50 per week, right? Whatever it makes sense to them. So at this point, you say, okay, cool, I'll pay your little interest rate or I'll put up the collateral, no worries at all. You're going to take those bikes, you will sell the bikes into the market for $100. That means that you now have $10,000 in cash, right? You sell the 100 bikes for $100, you now have $10,000 in cash. price drops down to $75 and you buy back the bikes for $7,500. Okay, so now you have all 100 bikes, but you still have the $2,500 in cash. You now all 100 bikes back and $2,500 in cash. Bank gets their bikes back. You pay them the interest and you get your collateral back. Pretty simple, right? So this is leverage trading. This is an example of leverage trading, okay? So you can do it by borrowing money, or you can also do it by borrowing assets. Both of these are 100% legitimate things that you can do on the market. So the bike example, I hope, makes sense. Now, replace every word in here that says bike with coin or stock. Okay, so the stock is $100. You expect the market to go down to $75 per stock. The bank owns 100 stocks. You go to the bank and ask for the stocks temporarily. You will sell the stocks into the market for $100 each. That means you now have $10,000 in cash. Price drops down to $75 and you now buy back the stocks for $7,500. You now have all 100 stocks back and $2,500 in cash. Bank gets their stocks back, you pay them the interest, and you get your collateral back. This is leverage trading. This is called shorting the market. Okay, so when you take them, when you go to the bank, ask for assets and sell those assets into the market, that's called a short position. When you go to the bank, ask for cash, use that cash to buy stock, hoping the price will go up, that's called a long position. So let's go ahead and get rid of all that. So borrowing money, expecting the price to go up, is called a long. Borrowing assets and selling, borrowing money to buy stocks, expecting the price to go up, is called a long. Borrowing assets and selling the assets, expecting the market to go down, is called a short. Okay, this is how this works. And I hope this makes sense because it's extremely important in what long and short positions are. Okay, so longs and shorts. 1 second. And for either of these things, you're going to have two things. The bank is going to want collateral and interest. So collateral, in case you don't pay back, they're going to get their money. And then interest is how much they're going to charge you over a set period of time for holding onto those assets or holding on to that cash, right? This is very simple stuff for what banks do. That's how they make their money. Now, the two examples I gave you are when things go well, okay? Both of those solutions or both of those ways made money, right? However, as we know in trading, things don't always go the way we're hoping so. Okay, so now let's talk about when things don't go well. So let's go over here and we're going to start our scenario all over again. Bikes are worth $100 each, right? You expect the bike to go to $75 each, right? Or I'm sorry, not 75. Take that back. Let's do the short long position first. $125 each. You borrow $10,000 and buy 100 bikes. Instead of the stock going up, it goes down. Bike drop to $75 each. You now have $7,500 worth of assets. All right, what happens in this situation? You borrowed $10,000. Do you just not pay the bank back? Of course not. That's not an option, right? Banks always win. That's the rule. The banks always want to get their money. They're always going to get their money. So what happens is that you have to have that collateral up, right? And that collateral will ensure that your position or collateral is insurance to the bank. Okay, collateral is insurance to the bank. So if you have $3,000 in collateral, is this position still open? Yes, it is, because 3,000 plus 7,500 is 10,500. That means the bank is still going to make their money off of this position, right? So the bank is currently holding on to $3,000. The price drops by 25%. You are still good. Your position is still liquid. It's still active because you have enough money to cover. You have enough money and assets to cover this amount. However, if this price now drops to 7,000, or let's do this. It drops to $6,999 worth of assets. Do you have enough money and assets to cover this amount? No, you do not. And if you do not have enough assets to cover this amount, you are forced by contract to sell. And if you are forced to sell, that's called a liquidation. Bank forces you to close your position to cover your original amount, right? Original amount loan. So you are required to cover it. This isn't an option. This happens automatically, and it's based upon the exchange itself. So if this happens, the bank now gets their money back, and you have lost your $3,000 in collateral. You think the bank's going to take a loss here? Nope. Banks do not lose in this situation. You lose $3,000 and the bank is out nothing. Okay, they will always get their money. That's very, very important here. Okay, so collateral, $3,000, and they covered it. So the higher your collateral, the more this movement can go against your position and you still be okay. All right, now let's go back to the other side as well. Bikes are worth $100 each, and you expect it to go down to $75. Actually, before we do that, I want to bring up one quick thing real quick, all right? Let's say you have $20,000 collateral for a $10,000 position. How much is what is the absolute worst that can happen in this situation? What is the absolute worst thing that can happen? Let's say the bikes are outlawed. For whatever reason, bikes are now worth $0. It is worth absolutely nothing. You now have $0 in assets, right? Is the bank still able to cover? Yes, right? You are still able to cover because you have enough collateral, all right? And the absolute worst that can happen on a long position is that your asset amount is worth $0. Okay, this is also very important to understand. You have an upside, or you have a limit as to how much you can lose on a long position. When we go to the short position, you'll learn that it's not the same. So it's very, very important to understand. So bikes are worth $100. You expect to go to 125, or they drop in price. You now have $0 worth of assets. And if you have enough collateral, then they'll keep the position open until you decide to close it yourself. If you don't have enough collateral, they will automatically close it, and it's called a liquidation. And I'll get more into liquidations later, but let's go to short positions. So bikes are worth $100 each. You expect the price to go down to $75 each. Okay, you borrow 100 bikes, right? You borrow 100 bikes and sell them into the market. So you have $10,000 in cash. So, price of bikes increase to $125 a piece. How many bikes can you buy with your $10,000 in cash? Okay, let me do the math real quick. Let's see. 10,000 divided by 125. 80. You can only buy 80 bikes with your funding, with your assets in hand. That means you're going to have to pony up for your collateral. You will have to pay the difference for the other 20 bikes. The bank is going to make sure they get their amount because the other 20 bikes have to be in here. So 20 bikes, let's see, 20 bikes times 125 is $2,500. So as long as you have more than $2,500 in this account, you're fine. But as soon as it gets above, or as soon as the amount of assets goes above that $2,500 that you need to buy, you're going to get liquidated, and they're going to force you to buy back in the open market whatever's available, so the bank gets their money, right? So the exact same thing, but the exact opposite. The exact opposite of the same thing. So you expect it to go down, but instead the price goes up. Okay. The bikes increases 125. You can only buy 80. So that means you'll have to pay the difference to the other 20 bikes. So you only have $8,000 in assets, or you have $7,500 in assets. Wait, I think I'm messing up on there. But there you go. All right. Either way, you can only buy. You only have 80 bikes of assets in your hand, or you can buy 80 bikes. So you have to pay the difference between the 20 bikes. So if as soon as this amount becomes where you no longer can afford the excess bikes or excess stock that you owe, you will get liquidated so that the bank makes sure to get their money, right? And they're going to keep the collateral. You're going to give them back their assets, and then you're going to call it good. But this will happen automatically without you having any control. Now, here's the next question for you guys, and this is very important to understand on this. If you're in a short position, how high can this number get? Can this number become 200? Yes. Can it become 500? Yes. Can it become 1,000? Absolutely. Okay. If it becomes 1,000, that means you can only buy 10 bikes. The other 90 bikes have to come out of your own pocket. That means unless you have $90,000 in collateral to buy the other bikes, you're screwed. Okay? Short positions do not have a limit as to how high they can get screwed. There is no limit. So short positions are inherently dangerous. If you are familiar with the GME situation with Wall Street bets and all that, this is essentially what they're trying to do to Melvin Capital. They are trying to increase this number so high that Melvin Capital goes bankrupt because they're unable to give the stocks back to the bank. That's what they're trying to do. And it's called a short squeeze, and it's very, very, very powerful. because they have to give the stocks back. The bank doesn't want the money. They want their original asset, which was the stocks themselves. Okay, just like the bank doesn't want money back. They want their 100 bikes because those 100 bikes are now worth a lot of money. They want those bikes back. They don't care about the money. They want the bike so that they can sell it or at least have that asset on the book. You borrowed bikes, they want bikes back. If you borrow stock, they want stock back. Whatever the price is irrelevant. You have to give them their bikes back or their stocks back, or they will liquidate you and then force you without you having any control over it. All right. So this is called a liquidation. Okay, so longs have no limit as to shorts have no limit as to how bad it can get to them. There is no limit. So I hope that makes sense so far. Let's see how else this works. Now for liquidations. Liquidations are mass liquidations, because if a liquidation happens, as you can see, as soon as the price, let me write it out actually, as soon as the price hits the liquidation price, your liquidation price, you are forced to immediately as soon as the price hits your liquidation price, you are forced to immediately sell or buy. You can't wait until the market stabilizes. You are forced to sell immediately. That means if you get one of those wicks, like we talked about in the previous video, that hit your price and forced your sell, it doesn't matter. As long as that a traded price went below your level, the bank will force you to instantly liquidate. No ifs, ands, or buts about it. You are done. That's it. Game over. And you are placed into a market buy, sell queue with other liquidations. So I'm gonna pull this up on Coinbase to show you how this would work in this sort of situation. All right, give it a second. So, as you can see, the market's crashing, but we already knew it was crashing because we've been on top of this shit. So, I'm not even concerned. I really don't care. This is totally expected from me, and I really don't give a shit. But regardless, though, so let's say we have Ethereum, okay, and let's say the market gets below this level, okay, and let's say we start liquidating. Whenever a short, let's say right here is a level right here. Yeah, this is a level right here. Well, if we have hit a liquidation level and it drops below here, what do you think that's going to happen to the price? Okay, if these guys who are in a long position and they now hit their liquidation level, and those longs are forced to sell, what happens to that price? It's going to drop a little further, right? That makes sense, because if they're forced to sell, they have to sell into the market, which is going to drop them down. Well, let's say that triggers more stops, or more stops, or more liquidations. What happens to the price then? It keeps dropping, and that may even drop more liquidations. And let's say it drops some more, and more, and more, and more, and it's a cascading effect of all these liquidations piling on top of each other, and they just keep happening. So all these longs get liquidated, and they start cascading on top of each other. They go into this massive queue, and all of this depth that's in here, right? All this depth, all these buys just start getting wiped out. All these getting wiped out because the price is getting drugged down because of all these mass liquidations that are happening, into where eventually the liquidations stop. And once the liquidations stop, then the market has this massive gap between this price, on this exchange and other exchanges, right? How exchanges are independent of each other. So now that the market is so far down, all the arbitrage traders and all the people who realize that the price is really low are going to jump in there and bring the price right back up. So when that happens, you have massive candles, and this is called a long squeeze. Whenever people are forced to sell, because of are forced to sell because of liquidations, and it cascades down the line. That's called a long squeeze. Now, the exact opposite can also happen. So let's say on here that, oh, okay, whatever. All right, I'll use it. Let's say people start entering a short position right here. Okay, but instead of the short position, actually, let's go over here. Let's find a better one. All right, this works. Screw it. So let's say people entered a short position and the price started going down, but then the price started coming back up, and now you started triggering these liquidations, okay? And not on the not for people who have to sell, but people who are in short positions. That means if they are in a short position, they now have to buy back the stock to give back to the bank. So they are now forced to buy back the stock. And what does that cause the price to do? Jump in price. And whenever it jumps in price, what that may do? It may cause other people to get liquidated and continue rising the price. And then more people get liquidated, which cause the price to rise back up, and price to rise back up, and price to rise back up. And as we know with the short positions, there is no limit to how far up the price can go. There's nothing that says the price can go no higher than this. Now, we know the price can go no lower than zero, but on the upside, there is nothing to say the price cannot go higher than a certain amount. This is why you see some incredible candles, some incredible wicks to the upside on cryptocurrency. It's absolutely insane. Let me see if I can find some examples real quick. I'm sure I can. It's not really that hard to find them. Let's go to some of these really small coins. I bet I can find it. Let's go to the 6-hour chart. Nothing really too good on this one. It's not bad. Nah, I don't like that one either. Not bad, but I could probably find better. KNC. I bet if we go to the Euro pairing, we can find a lot of really good stuff. Not bad. EOS. I'm not really finding any right now, but I know that there are definitely some that exist, especially on a lot of smaller exchanges. Oh, I know where to look. Okay. US dollar on Kraken. Ethereum, US dollar on Kraken. This is the Coinbase chart. Where's my Kraken chart? Where is it at? Come on, Kraken. There we are. All right. Kraken is known for having low liquidity. This is a beautiful, beautiful place if you're looking to see some incredible movements. So this is a great example of that. This is a daily chart, and I remember this when it happened. The price went from $1,700, or realistically, it went in the same day with $1,900 down to $600 or $700. Okay, $1,900 to $700, and it rose right back to almost where it started at. Okay, this is the definition of a short or of a long squeeze. Okay, this is a long squeeze because people started getting liquidated, and as they liquidated, they had to sell, and they had to sell, and they had to sell, and they sold. And you have to take whatever is available on the market. It doesn't matter what the price is. It doesn't matter. So even though you know in your damn mind that selling for $1,000 on Ethereum is a bad idea, you have no control over it because you are forced to do it, and you are put into a queue on selling. That means whenever you get liquidated, your order goes to the back of the line, and you're going to have to wait until all the liquidations that happened prior to you get filled first. Not only that, a lot of traders, like I mentioned to you guys, have stop losses in place, right? So as these stop losses get activated, they also get added to the liquidation queue. So what happens here is all the liquidity that exists on the exchange just gets wiped out, absolutely annihilated. And whatever is down there, no matter how incredibly low the bid, it has to get filled because the bank wants their money back, and this is how they're going to get their money back, okay? So this is a great example of a long squeeze. Now, short squeezes also happen pretty damn often. Let's see. I know Raven, if I remember correctly, had a pretty good one. There's the exact opposite also exists. That's what I'm going with here. You know what? I'll accept it. It's not great. I think Bitcoin Cash, Doge. I think it was Doge actually. I can't find any right now. Just know that long squeezes and short squeezes absolutely happen as well. So this isn't bad. I like this. All right. So obviously this is way back when, and even though they had a really bad deal at the time, it actually worked out pretty well for them. So in the long run. But this price went from $6 up to $8 in the span of probably a couple hours. Okay. An hour, maybe like 15 or 5 minutes realistically, because these squeezes happen very quickly. So the price rose higher than they were expecting, right? So they were in a short position. Well, since the price started rising faster than they were expecting, someone got liquidated. And when they got liquidated, they have to buy whatever was available. When they bought that, what happened to the price? It went higher, right? Which probably triggers somebody else to get liquidated. And what do they have to do? They had to buy. When they bought, they went a little higher. And then that probably triggers somebody else to get liquidated, which meant they had to buy, which went higher and higher and higher and higher and higher. And as it goes higher, more and more people get liquidated, especially in a short position, because shorts are unlimited potential on how much you can get wrecked, right? So it just kept going up and up and up and up. They all got put into a queue. The price went all the way up to $8. And then once all liquidations were filled, once the order book was cleared out and everyone got all the liquidations, got all their stocks back, at that point, then the arbitrage took place and all the opportunity buying, where then everyone went ahead and sold at the top and pushed the price right back down to the equilibrium. Happens quite a bit, okay? So this is a great example of a short squeeze. So Ethereum was a great example of a long squeeze. ETC is a pretty decent example of a short squeeze. I promise you, it gets much, 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 much more violent than this. I promise you. I just can't find any off the top of my head right now, but there are some absolutely astronomical short squeezes that have happened in the history of crypto. Okay, I'm talking like several thousand% in the span of like 15 seconds or 15 minutes. Okay, and people get absolutely wrecked. Absolutely wrecked. So that's what liquidations are. The impact in the market is incredible. Okay, these short and long squeezes are absolutely incredible. So let's go to Bitcoin as of a couple days ago. April 17th, we had a pretty decent crash. So let's go to that real quick. If I can go and find it. Where are you at? Where are you at? Where are you at? There you are. All right. So this drop right here. This drop right here. This was a pretty decent drop, around 20%. Not anything outside the realm of possibility, but about a 20% drop. This is an incredible number. Let me find it real quick. Oh, 15%. That's not even that bad, honestly. Even though it was only a 15% drop, people were getting so euphoric in this market on how Bitcoin just kept going up, kept going up, kept going up. Everyone got euphoric. And whenever they got euphoric and how it's going to, if you long the market, is guaranteed cash. If you long the market, it's guaranteed cash. So people kept getting really, really involved, putting more and more money into it. And then whenever it dropped, the people who were way out of position got absolutely wrecked, okay? So people who were over leveraged, like we talked about before, didn't have enough collateral in place, had way too much leverage, way more than they can afford. These liquidations started happening. There were, I have a number right here, there were $7.4 billion in liquidations in 1 hour. $7.4 billion in liquidation in 1 hour. That is a number that's astronomically high, right? That's just incredible amount of money that gets wiped off the market. in the span of 1 hour. So that just gives you an idea of how much strength these leverage positions have on the market. Okay, and all these people, $7.4 billion were forced to sell. When $7.4 billion is forced to sell, that drives the price even further down. Okay, some smaller exchanges got hit a lot harder than this one. Just understand that it just gets very, very violent. Okay, very, very violent. So now you understand the fundamentals of liquidations and shorts and longs and all that. Now you got to understand a concept that I like to call whale fuck games. Okay, whale fuck games. Yes, you heard that right. Whale fuck games. This is a very, very important concept that's extremely important to understand what all this means. Basically, what this means is that no matter how good of a position you are in, no matter all the technical indicators and everything telling you that this is going to go up or whatever, right? Just like over here, I was explaining how incredible of a position it was for us to buy in this area. That was just the perfect spot to do so. And I went through there and I did a ton of technical analysis. I analyzed this really, really well. I had all my indicators telling me one thing, and I was like, this is the perfect play, right? But what happened, though, is that the whales out there realized that even though this was the perfect place and everyone's going to buy right here and get over leveraged, and because people were so euphoric and so bullish, if they could make this price drop just a little bit, if they could put enough money to drop this thing just a little bit, they would force liquidations to happen that would drive this price down tremendously. So they probably put a few $100 million into this, which sounds like a lot to us, all normal people, but they probably put a few $100 million into there to force $7.4 billion in liquidations, right? So they pushed the domino, started this trend, and once it started, the liquidation started happening, and it kept going down. And what do you think what do you think these whales did who started this? They sold right here, like a few $100 million worth of Bitcoin, started liquidations. What do you think they did when it got to this point down here? They bought, right? They bought right back in. So they sold their few $100 million at 60,000, and they bought down here at 50,000. They made around 20% profit in the span of 8 hours. Okay, like when they have so much money that they can do this, the amount of power that they have is insurmountable. And you always have to remember, no matter how good of a trade you are in, no matter how well positioned you are, no matter how confident you are in that trade, there's always a whale out there bigger than you, ready to push the sell button or the buy button and fuck you up. You are just a small little minnow swimming in an ocean that has these massive whales just lurking around waiting to cause havoc. And the reason why they're going to cause havoc is because they can find an opportunity where they drop the market by 20% and then make 20% or 20% gains. So they turn that few $100 million into 20% more in the span of 8 hours. This is 100% legitimate in crypto. It does not happen nearly as much in the traditional markets due to a lot of regulations and oversight, but this is crypto. Crypto doesn't have all that stuff. Crypto doesn't give a shit. This is the honey badger of the market. You must understand that these whales are in charge and you are playing their game. If you ever forget about them, you will get fucked. Okay. So now at this point, let's start looking at ways to identify whether or not a market is over leveraged or out of position. So the first thing we're going to go over is what's called funding rates. Okay, this is view based. This is a way that you can look at funding rates. This is for futures, but it gives you a good idea of how bullish or bearish the market is as a whole. This is how much money the bulls. Or let me rephrase it. If it's green, that means that longs are paying shorts. That means the longs are paying interest to short position people, right? People who are in shorts. So on here, they're paying 0.0134% of their entire holding to the people who are shorting this position every 8 hours. Okay, it doesn't sound like much, but it does add up pretty quickly. So like here at BNB, 0.05% every hour or every 8 hours to the short positions. Now, whenever you find some red down here, so GRT, this means that the shorts are paying the longs 0.0123% to the long positions every 8 hours. This is on futures, not on traditional markets, but this is a really, really great way of seeing if the positions are, if the market is over leveraged or not. Now, so if there's a ton of green on this market, especially like here with Doge, okay, with Doge, with SNX, with Luna, with Maker, with Sushi, especially with Near, all these ones, this means that there are a lot of people paying a lot of money to the short positions. What that means is that these guys are what's called out of position. They are over leveraged. That means that the market is due for a correction. And when I mean correction, it means the market's going to come in here and absolutely destroy the people who are out of position. So all these guys who are over leveraged the long positions are waiting and waiting and waiting for the whales to come up here, wipe them out to do what's called resetting the funding. And when they reset the funding, everything gets back to a static zero, like Bitcoin right now. Static zero. Why is it static zero? Because we're getting liquidated right now. Look at that, right? And so because we're getting liquidated, the whole market is getting reset on the funding. Let's see. I think it resets every 8 hours. Let's see if it does it or not. Yeah, about the same. But as you can see, right, like this is important. So this only applies to futures, but it still gets you a good idea of the overall sentiment. Next one. Fear Greed Index. This is a great one, okay? What this means is that the Fear Greed Index is how greedy compared to fearful the market is. When the market is over greedy, that means that the longs are extremely out of position. It means they're euphoric. That means that they're thinking that the market's never going to correct. Everything's going to keep going higher forever, and they're over leveraging and throwing all their money in there and everything else. And whenever this gets down here to the 80s and 90s, anywhere in that area, better start getting ready because it's about to come out and wreck the market. Okay, there's a few different fear greed indexes out there, and there's a lot of information as to why they do what they do. But this is actually for this is not for the right one. Fear greed index crypto. There we go. This is what I'm looking at. There you go. So right now it's very greedy, okay? And since it's very greedy, we're still looking for a major dump, and I'm expecting a major dump to happen soon because what I've been updating you guys recently. When this is the other side, like when I was in the harsh bear market and the Bitcoin was dead, it's over, yada, 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 right? You know what I was doing? I was buying. Over here when the fear was at the absolute max, I was buying because that tells me there's a lot of opportunity for the price to go up and wipe out all them over short positions, okay? Next indicator that you can use, go to the BTC technical or mine BTC technicals, and you can actually look at the short positions and the long positions. These are the open shorts and the open longs. When there's a lot of short positions or the shorts are on the rise, that means that the market is getting bearish, right? But as you can see, we've already dropped the shorts quite a bit, right? So, and the longs are still pretty damn high. We're still waiting for a really, really good flush. So because of this, I have to remain bearish on Bitcoin because those open long positions, when or if they close or get liquidated, that's going to drive the price down. A lot of extra long positions drive the price down, and a lot of extra short positions drive the price up. So as you can see, there's really not that many short positions available. So because of this reason right here, it's really hard for me to be bullish on Bitcoin. And instead I have to be bearish on Bitcoin, okay? There's a lot of other reasons as well, but just understand that. Let's see what else. So we've went over funding. We've went over the fear greed index. We've went over the long and short charts. For the future rate, I forgot to mention this. Usually what you're looking for, 0.01% is normal, okay? That means essentially neutral. That's what we're expecting to happen. This is what you generally get reset to. So whenever it gets anywhere near that level, that means that it is essentially a neutral market for the funding rates. That's good. That means that now it's able to continue back up. But growth, sustainable growth, cannot happen when the funding rates are too high. Everyone's on pins and needles waiting for it. So these liquidations, these mass liquidations are actually healthy for the market. So while everybody else was boo-hoo, the market's over, we're all going down, it's all over, yada, yada, yada. Whenever the market crashed by 15% a couple days ago, I was like, cool, this is great. Keep liquidating them so we can continue up even more harshly, right? This will help us build a strong base so we can continue up. All right. So now my last portion on here is going to go over how to avoid the whale fuck games. Okay. How to avoid the whale fuck games. Well, let's go back to my chart. Let's go ADA. ADA is going to be my one for today. Let's go back up here. How to avoid whale fuck games. 1, don't use leverage. Guys, I know this is stupid, and I'm like probably gonna be a lot of people fighting me on this, but I don't use leverage anymore. The only time I ever use leverage is when I'm gonna be doing a hedge on my long position. If I am short-term bearish on my long position or on my spot positions, then I might open up a hedge short position just to make sure that I don't lose my I don't lose too much money in a minor drop. Okay. You don't have to use leverage to make money in this market. It's already volatile enough. If you use proper strategies, you'll be safe. Also, you can't get liquidated on your own positions. Liquidations only happen when you're borrowing money. If you don't borrow money or borrow stocks, you don't have to worry about someone else taking your money or taking your stocks or forcing you to sell. They're yours until you decide to sell. All right. So, just not using leverage is absolutely 100% a viable strategy, and I recommend it, especially if you're a new trader, because these liquidations will absolutely wreck new traders, and you must be careful. All right. If you do want to use leverage, that's great, and I'll try to teach you the best I can on how to do so. But I'm recommending anyone in this group, especially if you ever traded before, stay the hell away from it. There's no reason to touch it. Now, if you do decide to use leverage, no more than 5% of your entire portfolio can be exposed to a leverage trade. What this means, okay, I want to make this very clear. That means if everything goes to shit and all your positions get liquidated, okay, every one of your positions, you will only lose a max of 5% of your entire portfolio. Okay. Reason why, we've talked about how incredibly volatile crypto is already. We talked about how these long and short positions, how much you can lose and the over leveraging and how you go into a queue for liquidations and all that craziness. All right. This will help you have some exposure to leverage, but it will make sure that you also have majority of your portfolio in a spot position where no one else can take you. I posted a picture. I posted some pictures in the group a few days ago during the April 17th crash, where someone went in there and talked about how they lost all their money and they're gonna have to get a part-time job and they were crying and everything else. That's because this guy risked way more than 5% of his entire portfolio on a leverage trade. He risked literally 100% and then he got burned. Okay. Now the next thing on here, no more than 1% of your portfolio can be exposed by a single position. That means that Even if you are 100% confident that this is going to be going up or down, right? You are 100% confident. You will still not risk more than 1% of your total portfolio on a single position. That means that you can have no more than 5 positions open at a single time, because that would mean you have more than 5% of your total portfolio exposed. Okay, these are really, really good rules to follow, and they will preserve your assets, because capital preservation is the most important thing. Okay. All right, number 3. Take advantage of limit buys and sells. Like I showed you guys, this market is very volatile, right? Go ahead and place some stink bids out there. So let's say a mass liquidation happens on short positions or on long positions, right? And they're forced to sell. They have to buy whatever's available, right? So what harm is there in you putting some bids out there at really, really low amounts that you're thinking it will never get filled, but because of these positions getting liquidated, you might get lucky, or someone has their trigger finger all messed up and they click market sell when they meant to do only for two Bitcoin, and instead they accidentally sell for 200 Bitcoin. Whatever's available on that exchange has to be given. So if you are the next one up, you very well make it a really, really, really good buy. On the other side, if you want to go ahead and try to sell your position for way more than it's worth, if a short squeeze happens, they have to buy whatever's available. So go ahead and just place those positions out there. Who knows what's going to happen, right? Some absolutely astronomically high, stupid amounts, stink bids, might get filled. So throw it out there. Who knows what's going to happen? The only thing you got to worry about that is opportunity cost, right? Instead of waiting for something to happen, you may want to put in something you know will get filled if you think the market's going to go up or down. However, if you have the extra money laying around, you want to throw some stink bids out there, go for it. No worries about that at all. All right, number 4. Tight stop losses. We talked about this in the risk management video. Tight stop losses are key. If you are going to do leverage trading, you need to be aware of the queue for liquidations. What that means is that if you have a really, really loose stop loss and you wait until the absolute last possible time to do a stop loss, when that stop loss does get activated, you're going to go to the back of the line. That means you're going to get whatever's available after all the other liquidations are done. So if you have a tight stop loss really close to your current price action, as soon as your trade is liquidated or as soon as your trade is invalidated, you get out of the market. Why? Because you're going to get filled first, and then all those liquidations and loose stop losses will get filled after you. So you get the the reasonably priced coin or the reasonably priced sells, and everyone else gets the stupid ones where they're paying way more than they should, or getting way less than they should for their coins. So those tight stop losses are key when it comes to any sort of liquidations. And it also makes a lot of sense. As soon as your trade is invalidated, you're trading on hope, and hope is bad, right? You want to trade on systematic and logic, and if you're trading on hope, that's not systematic or logical. So that's all I have for this leverage trading introduction. I know it's a lot. I know there's a lot going into this and everything else, but it's a very, very, very important, concepts to understand. I didn't go into exactly how to do leverage trading, and that's totally okay. There are plenty of other resources out there if you do want to dive into that and make it happen. Just be very, very careful. I cannot stress that enough. This is how you lose all your money. This is how you lose everything, okay? As long as you do spot trading only, you own your stock or coin or commodity, and no one can take it from you. If you borrow money, the bank can force you to sell or buy, and then you are left with nothing. The bank does not lose. The only losers are people who trade with leverage. The bank will never lose. They will never take a loss, and they will insure of it. So just be very, very careful you're doing so. That's all I got. The next video will go over how to read a chart, and then we get into the indicators, and then y'all will be ready to roll and make things happen. Like always, let me know if you need anything or have any questions, and I'm going to let you go. Have a good one, guys.